In this video, I want to highlight event-driven investing. How to profit from market-moving events. Events happen virtually every day. To the ordinary person, it doesn't really doesn't make any difference. But to a typical investor, to an event-driven investor, these events may have an impact or impacts on the security prices in the markets. So event-driven investing is a strategy that seeks to profit from stock price movement caused by specific events. These events can be corporate actions, economic data releases, regulatory changes, or even geopolitical developments. Here is a breakdown of how this strategy works. I want to consider key events in event-driven investing. Number one is mergers and acquisitions. Mergers and acquisitions. Investors anticipate how a merger or acquisition might affect the companies involved. Typically, the target company's price rises while the acquiring company stocks may fluctuate depending on the perceived benefits or cost of the deal. The acquiring company, the company that wants to buy another company will have its own share price drops, while the company they want to acquire, they want to buy, will see its share price, rising, and people tend to benefit from these particular events. Number two is earnings announcement. Companies report their financial performance quarterly. Positive or negative surprise in these reports can lead to significant price movements. I think, from my experience in the markets, I think over around 18 years or so, I discovered that usually what tends to move the market the most is this earning announcement, because during earning season, usually it is done quarterly. As companies are bringing out a result, the ones that perform, very well will have their share price increase, while those that perform poorly will have their share price dropping. So you could benefit from this particular movement. You target companies you feel will come up with positive news, and you buy into their shares. And as the news comes out, you discover that the price will rise, and you stand to make profit as a result. Number three is bankruptcies. Bankruptcies. When a company files for bankruptcy, its stocks often plunges. However, some investors may speculate on the potentials for restructuring or a turnaround. Usually, when a company wants to go into bankruptcy, they make an announcement, and then some kind of investors will target this kind of opportunity, hoping that the company will be restructured successfully. And if it is done, successfully, discover that they will then realize real value for their investments. But if the restructuring or the turnaround is not successful, may end up losing money. They are called distressed investors or distressed investing. You equally have number four, product launches. The success or failure of a major product launch can impact a company's stock price. For example, tech companies often experience significant price movements around new product releases. Tech companies like Apple, like Samsung, when the latest iPhone is about to be released, most of the times you discover that it will then affect the share price, one way or the other. Number five is regulatory changes. Regulatory changes. So new laws or regulations can dramatically affect industries. For example, environmental regulations might impact energy companies, while changes in healthcare laws can affect pharmaceutical and insurance companies. So certain regulations can, when it comes, it may affect the company sometimes positively and sometimes negatively. And these effects will certainly resonate with the share price. The price, will rise if it does positively, and the share price could drop if the regulation in question affects the company negatively. We want to look at the strategy that is adopted for this particular investing or event and driven investing. Number one is arbitrage. This involves taking advantage of price discrepancies between before and after an event, such as buying a stock before a merger and selling it afterwards if the prices rise. Usually, it's based on news events. You hear in the news that a particular company is about to be acquired. You buy the stock of that company. So all things being equal, after the acquisition, the stock of the company is expected to rise. Okay, while you either sell short the acquiring company. So that is how arbitrage could be utilized to make money. Number two is a speculation. Investors might take a position based on their prediction of how an event will unfold. For example, they might buy a stock if they believe a positive earnings surprise is likely. If you believe that this company is likely to do well in the next quarter, you could speculate. You could buy the stocks, and then if it actually does well, you stand to make profit. Number three is hedging. Hedging is also a notable event-driven strategy. Some investors use event-driven strategies to hedge their portfolios against potential risk. For example, they might short, a stock if they believe, a negative event like a regulatory crackdown is likely to affect that particular company, and they will go long on a company they believe that a specific regulatory action will affect the company positively. We want to look at the risk and the rewards of event-driven strategies. You have volatility is a very important risk. Event-driven investing can be highly volatile. The outcome of an event is often uncertain, leading to potential gains or losses. Nobody can categorically, 100% be sure of the outcome of a particular event, and so that volatility, is always there. It's highly volatile in nature, and if you know particularly what you are doing and you could really predict the outcome of an event, then you stand to gain tremendously. Number two is information advantage. Success often depends on having better or faster information than the market. This can be challenging as many market participants are analyzing the same events. It's difficult for one to actually, predict an event successfully. Some can predict the effect of an event. If let's say two people are analyzing an event at the same time, they are likely to come up with different outcomes, and those outcomes, will equally define how they invest in that particular opportunity or not. And so whoever is right will likely make profit, and whoever is wrong will certainly lose money in the process. I want to look at the tools and analysis adopted or used for event-driven investing. Number one is newsfeed. So real-time newsfeed are crucial for staying informed about potential events. You have to make sure that you are current when it comes to market news, when it comes to economic news, when it comes to news that could affect your investment one way or the other. You make sure that you stay current. Number three is research reports. Analyst reports can provide insight into the potential impact of events on stocks. You make sure that you are always updated when it comes to analyst reports. Usually, these people are very experienced, they are quite smart, they are very skillful, they are really intelligent, and they do this for a living. They analyze companies. So make sure you key into the result of the analysis. That will then help you, to help you tremendously in, outperforming the market, as the case may be. You equally have quantitative models. Quantitative models, yes, some investors use models to predict the likelihood and impact of events. Please don't forget to like this video and subscribe to this channel. It will do me a tons of good. There's this particular funny story of an individual. It should be a trader that used the migratory route of elephants in Africa to design a software that he utilizes in trading the market. Well, I don't know how effective it is, but the matter is just that he kind of analyzed the route these migratory elephants take, and he used that particular event to design his trading software. You come across things that could be considered, should I say, funny or whatever in the market, but people still devise means of making money, which of course is quite interesting.